Yeah, that's right. We're back, and this ain't my first mortgage podcast. Welcome to the show, where we discuss all things mortgage sales, industry news, interviews of the top mortgage professionals, and more. Strap on in, enjoy the ride, and welcome to Ain't My First Mortgage Podcast. Paul, welcome to Ain't My First Mortgage Podcast, buddy. How we doing?
Good. How about you, Skip?
Man, I am great. It's Friday, going into Super Bowl weekend. I mean, what more could we possibly ask for? So, how's everything up there in the New Jersey area? That's where you're at, right?
No, but we're headquartered in Jersey, but I live in Ohio, and
How did I not know that? I thought you were there with everybody else.
no, I work from home every day unless I'm on the road.
Oh,
So,
man, that's the way. Yeah, I mean, I knew that you worked from home. I thought you were over in Jersey. Okay, so what part of Ohio are you in?
I'm in Dayton, Ohio.
Dayton,
So right
Ohio.
between Cincinnati and Columbus.
Yeah, man. Yeah. Well, welcome to the show. You already taught me something I knew I didn't know about you, see? So that's great information. Do me a favor, listeners, they don't know you yet, but they're going to. Go ahead and take a second to introduce yourself.
Yeah, my name is Paul Sushereba. I've been around the mortgage business since 2010. Right now, I run non-QM, the non-QM division for MLB Wholesale and Retail. I'm also about 15 years in as a producing mortgage loan originator. So I haven't originated in a minute here, but I did most of my time as a producing branch manager in the industry.
You did most of your time like it's a prison sentence, man. I love it. Yeah, so your background's similar to mine. That you spent a good chunk on the origination side, and that's been a good chunk on the account executive side. So you are the non-QM specialist for MLB, right?
That's
And
correct.
that's what I want to talk to you about today, man. There's a lot going on non-QM. Now, I don't want to assume that everyone knows about non-QM who's listening. You should, but if you don't, you know what? You've tuned in correctly. Give everyone literally like the quick overview of what non-QM lending really looks like.
Non-QM really has two facets. The primary facet that most people probably know about is DSCR lending. So lending for business purpose on investment properties, primarily 1 to 4 units, but there are options out there that go beyond that to 8, 10, 20 units. And the other side of it is helping self-employed borrowers or borrowers with some more challenging income structures. So really looking at bank statement qualifications, P&L qualifications, 1099 borrowers. That's really what non-QM is strong at and built for. It's not subprime though, right? It's not going back to the pre-2010 subprime days. It's good loans to well-qualified borrowers with just alternate sources of income.
Yeah, that is one of the most common misconceptions about non-QM lending. These are strong borrowers, and a lot of times, if you were to put an agency loan next to, or an agency borrower next to a non-QM borrower, without knowing anything else, you'd be like, I'm the pick the non-QM guy, because it's heavily, they've got a lot of liquid assets. They have strong credit. They're putting a lot of money down, those types of things. And so that's really important. All right. So talk to me a little bit about the non-QM space right now. There's a lot going on with it, and I'd love for you to comment just for a few minutes about some of the changes that are happening, some of the things you see on the horizon. Just give it all to me, man.
Yeah, so last year was kind of like AI, right? Last year was a breakout year for non-QM. In the same caveat, we've seen a lot more offerings, a lot more activity in the space as people get more comfortable with it. We're seeing more performance data that's hitting a 10-year plus period, so there's more interest in the secondary market. DSCRs have become massively popular, but with those great strides in growth, we're also seeing some growing pains. And one of the big things that people need to be very cautious of, especially in the DSCR markets right now, is you're seeing geographical limitations on where we will and won't lend on those DSCR properties. Areas like Philadelphia, Pennsylvania, Baltimore City. We're seeing Indianapolis, Indiana. I just had one come across my desk as well for some caution to be observed in Memphis, Tennessee. We're seeing a lot of fraud in some of these markets, both around occupancy. So somebody trying to utilize a loan that's meant to be business purpose investment to live in themselves or to put a family member in, which is not allowed. And we're seeing that become more aggressively pursued by servicers. So it's, kind of a do not tread area now in the non-QM space.
Interesting.
You used to be able to get away with it, but it's actually being looked at and pushed now.
Yeah.
And we're also seeing appraisal fraud in those markets, especially on cash out deals. Philadelphia and Baltimore specifically, we're seeing some serious headwind there. They've virtually wrecked the row home market due to that fraud. We can't get a valid valuation
Wow.
due to the amount of fraud that was present. So we're seeing some of those growing pains. We're seeing investors kind of clip back a little bit in the risk they're willing to take, but they're doing it to preserve the product as a whole.
Mm-hmm.
And we're still seeing some things become more aggressive. We're seeing 90 LTV become a more popular option on the alt doc side. We're seeing a lot of growth in the way we can calculate bank statements even over a 12-month period for a younger business, because we're seeing the performance data become age on that and opening up some of those pieces. So I think today, if you're not looking at 25% of your production this year being non-QM, you're likely going to fall behind the market in terms of the offerings you have for those clients, because there are a lot more self-employed people out there today, even if it's only in a part-time self-employed capacity, right? You're driving Uber or DoorDash to supplement your standard income.
Yeah, I know. I love that. So let's take a step back though, and let's look at this from a loan officer perspective, and maybe one that hasn't gotten into non-QM. And they're like, hey, and they call you and say, hey, Paul, listen, I know that you're the man over there at MLB for non-QM. I want to sign up with somebody that offers that. But I need to know, how can I start to augment my business with this? Because I can't become a non-QM expert on all these products. Every investor, they may have similar products, but unlike agency, they all have their different nuances, right? So how can I start to build business using non-QM?
The first thing that I'll tell a broker that I'm talking to for the first time, I do like to tell everybody that, hey, don't worry, it's my first non-QM loan too. We'll learn together. So we'll treat it like that, right? Let me help you. Let it somebody that knows what they're doing help you structure that deal. You should have at bare minimum a very reliable and educated account executive that has the capability to walk you through the nuance of their guideline, because non-QM is all about the gray area and the nuance. Every single file is a manual underwrite, which is a great thing in terms of flexibility. It lets us color outside the lines and around that gray area where things just plain make sense. But it can also be a stumbling block for you if you run into something in that gray area you can't work around, you can't explain.
Yeah.
And you need some experience to navigate that market. But the big thing is, don't be afraid of it. At its core, non-QM starts with Fannie Mae guidelines. Yeah. Almost every non-QM set of guidelines is a Fannie Mae conventional loan that's been tweaked. That's right. We're just tweaking that way we look at income. Yes, there's different LTVs for credit score based on the income type that you're calculating with. But at the end of the day, you're still putting together a standard loan package for a conventional loan. It's just that in place of those W-2s and pay stubs, we're using 12-month bank statement, or we're getting a P&L from a P10 provider or a CPA.
Yeah.
So don't overcomplicate it either. Be cautious of the nuance, but don't think it's a whole new learning curve. Right. It's something you really can spin up on pretty quick.
I love that. So if I'm an LO wanting to get into this and I say, hey, I'm going to partner with you, what are some of the most common things you see for a reason to say, hey, look, conventional loan, government loan, whatever is missing a piece, but it will fit into the non-QM space?
So some of the great things, number one, if you're talking to an investment borrower, you should be defaulting to DSCR at this point.
I agree with that.
The ease of getting that loan closed, the lack of complexity, the rates are almost identical, especially with a prepayment penalty attached to the loan, to that agency space, and just significantly less complex.
Yeah.
Same is true of a second home. With Fannie Mae's LLPAs on a second home product right now, it's really possible you get a much better rate in non-QM, not just the same rate. So second homes are a great place to also identify non-QM opportunity, even for a full doc borrower.
Love it, love it.
But when we get to that primary purchaser that might qualify conventional on the surface, you're looking for borrowers that need some additional income. They've written off too much on their taxes. They've got a great W-2 job, but you're stuck at a 57% DTI, and you need to find a way to use the $800,000 in their 401k to help cushion that payment to get them to qualify. You're looking for the borrower that is a W-2 something or other, but they drive DoorDash and Uber in the evenings, and you need to blend both those incomes together.
Yep.
We can do that in a much more effective way, giving them significantly more credit for that self-employed income than you can on the agency side, because it's not about taxes for us. Matter of fact, I don't want to see a tax return in our files. And we're looking at the business cash flow generation versus the claimed income. So it's a very different look, but it provides a much higher number. And I'd argue a much more reliable view of the actual business operation.
That's true, because you have to really get down into some of the finer details, not just the big tax return that doesn't really tell you a whole lot. So, it's kind of a thing. So I'm going to give you a chance here. I'm going to give you a chance here for a shameless plug. All right, for a shameless plug of MLB. What are some of the new things that you've seen roll out here that you think will really make a big impact on non-QM production for your broker clients?
So for me, I've got two parts of our program that I think are drastically underutilized and can really help brokers with a wide spectrum of borrowers. The first one of those would be our mix and match program. A lot of programs out there have a limited amount of flexibility in terms of mixing income, especially for one borrower. If you're a bank statement borrower, 51% of your income's got to come from those bank statements. We don't have those kind of limitations. So I will look at all the non-QM income types where they make sense on a file for one or multiple borrowers, or even a non-occupying co-borrower. And that gives you the opportunity to have a W-2 borrower that drives Uber and DoorDash, but also needs asset depletion, while the wife is over here on 1099 income as a travel nurse, and blend all that income together to get somebody across the finish line. So that, to me, is a really underutilized and very powerful tool. But you need to know how to structure that as an LO, and you need a partner that'll help you structure that, which is what we do at MLB. We're really focused on building that partnership. The other component to that is our asset utilization program. Yes, you can have $1 million or $2 million in the bank, deplete that over a 60-month schedule to generate some income, but that's not where the power really is. The power comes into that file where you're at a 57% debt to income ratio, and you just can't get it below 50 to qualify, but you got about $100,000 or $200,000 in your 401k. With our asset utilization program, in that kind of scenario, we'll deplete the income over 36 months, which can turn 100 or 200,000 into enough to drastically close that gap and get you across the finish line. So it's not got to be a self-employed borrower only scenario. It can save your butt on quite a few conventional loans as well.
So that's actually really cool. It follows that the 3-year continuance kind of rule for that. Right. So that's very interesting. All right. So before we start to wrap up here, what else would you like to share? Be sure everyone out there knows about the non-QM space, man. Because I know it's your little baby. So
it is my baby. You made a point earlier, right? That as much as I'd love to be the right fit for every loan, I am not going to be. The non-QM space is very covered in nuance, and everybody writes their own guidelines. So you can't assume that just because I can't do it or somebody else can't do it doesn't mean somebody else can. You got to find the right home for that borrower and that mortgage. But having a good partner that knows what the competitors offer, what they can do in their guidelines to help give you some direction, a real non-QM expert, is critical because of the vast amount of options that are out there compared to conventional. The other piece is that it changes much more frequently, and we're going to see continued change this year. I think we're going to see some regulatory change in which states allow unlicensed DSCR. I think we're going to see change in how non-QM loans are reported to regulators and in the space overall as it becomes more popular. That is going to be a persistent theme in the non-QM space, is just change in and of itself, as we see what risk dictates and where things move. So stay on top of the matrices, right? On Fannie Mae loans, you have DU. DU is where you go to get a quick check on, is this borrower approvable or not based on the information I fed it. In the non-QM space, use the matrix published on the lender's webpage in place of that. That is your DU. Actually, DU has the same thing built in the back end that you never see.
You're literally checking boxes.
Manual process. You're literally checking boxes. 90% of your questions on a file will be answered by that matrix. So learn how to read those. Have somebody teach you how to read and apply a matrix, and you'll be 10 steps ahead in the non-QM space.
Isn't it funny? It's like That's, using the matrices is what I used back in the day when I was first starting to originate. And now it's
Yeah,
come full circle again, man. But
full circle.
without uniformity, that's what you have to do. And
Yep,
so,
yep.
it's just all part of it. So I'm kind of curious. This is going back to what you mentioned a minute ago about the increase, or at least the more visibility, or the more visible that mortgage fraud has become. Do you know the and I'm completely putting you on the spot with this. I don't know if you'll know this or not. Do you happen to know maybe what the percentage of non-QM loans that are found to be fraudulent versus agency government?
I don't even know that that's a number that you can aggregate
Oh yeah, I
because
mean, precisely no, definitely not, because you would be able to
yeah,
look for years and years down the road. But I didn't know if you had somebody
well,
venture a guess at it or not yet.
beyond that, with Fannie and Freddie, you have the clearinghouse, right?
Right.
Everything gets sent through the clearinghouse. Every Fannie and Freddie loan goes through the same securitization process.
Hmm.
In the non-QM space, you don't have that. You've got people selling to other Wall Street investors. You've
Yeah.
got people selling internally to other non-QM producing companies, and then they sell it to Wall Street investors. So all that paper is traded privately.
Yeah.
There
There's
is no
probably on
necessarily
yes and
national
tough.
aggregate
Yeah.
number.
Yeah.
But the fraud and the performance data, for the most part, does mirror conventional in
Mhm.
terms of the amount of delinquency that you see, maybe a little bit higher in the DSCR space. But from a fraud standpoint, especially in DSCR, I would venture a guess that you're looking at 10 to 12% of all the loans that get thrown into the hopper, so to speak,
That's rough.
do have a fraudulent component to them.
Yeah, see, that's a problem, man. That's something we're going to have to deal with. And
It is.
then the faster we get ahead of it, the better it'll be for everybody.
And with the advent of AI, AI presents some challenges, right? It can develop bank statements for you that don't actually exist,
Yeah.
but it also gives the ability to quickly scrub data and find occupancy fraud, find other opportunities for fraud, like in these valuation tools with the AMC and appraisal fraud.
Mhm.
So you're finding lenders starting to leverage that to push back. And I think the industry as a whole, in a self-preservation mentality, right? If we let too much of that fraud go through, we're not going to survive.
Yep.
But it's got to be able to be stopped at the LO level and at the wholesaler level, all the way up the chain into securitizations. Because in order for the industry to survive, the non-QM component, we've got to keep that fraud as limited as possible. So you're seeing
Sure.
some aggressive action taking place in that realm last year, this year, to help prevent that even more with the advent of the AI tools making it faster to scrub.
Yep. Yeah. Very true. And that's one of the things. It's like, I think non-QM obviously it's here to stay. We just got to be sure that we keep it viable, because it really does provide a good service to a large chunk of the population. So, all right. Before I go, I want to ask you about one other thing, not mortgage related. Now, if memory serves me, you are a triathlete. Is that correct?
I am.
Okay. Tell me how you got into doing that.
I was a cross country runner, distance runner, way back in elementary school and high school. Ended up into a knee injury that gave me significant problems. And a guy at our church got me on a bicycle, and I just fell in love with cycling.
Really?
And
Okay.
that figured I'm already able to run. I was able to heal back from that knee injury through cycling, built some strength, and got into doing a lot more cycling than running. But I was back to running a little bit, and I figured, why not throw a swim in there and try something hard? And just kind of honestly, more than the racing, I fell in love with the training. That's the way to keep my brain clear, my mind clear, and I
Yeah.
like being out there on my own, training by myself.
So are you still actively doing races, or had you hung it up?
I'm hoping to get to a point where I actively do races, but if I'm honest, I spend way too much time trying to build this company and work right now
For some business, yeah.
with a 5-year-old at home. So the opportunity to train enough to be competitive at racing,
Mhm.
and I just can't race and not try to be competitive. It's not
Yeah,
in me to not
that's
be
on your
competitive.
DNA, man.
Now,
No, I get that. Very cool. Well, listen, Paul, if anybody wants to get in touch with you, where should they go? What should they do?
yeah, so you can find all the information about our non-QM programs at MLBwholesale.com. Feel free to reach out to me. There's also an non-QM hotline published right on the webpage there. That number is always open, ready to go. Man, from 7 a.m. to 7 p.m. Eastern Standard Time, Monday to Friday. And email and all that are on the webpage as well.
Hey, so can both active and non-active customers still access that hotline?
Everybody can access that hotline. It's published right at MLBWholesale.com.
All right. See, so you'll even help them before they sign up with you.
Absolutely. Yeah. The best thing to do before you sign up is call us, help you structure the deal so we can help you figure out where that right home is. That's right.
I love it. That's good stuff. But listen, really appreciate your time this morning. Non-QM, very important. They don't come any more knowledgeable than you on this. So listen, I appreciate it, and we'll talk to you soon, man.
Thanks, Jeff. Have a great day.